Hello and welcome to the Morningstar series, Why Should I Invest With You? My name is Emma Wall and I'm here today with Michael Hulme, manager of the Carmignac Portfolio Commodities Fund. Hi, Michael.
Hi, Emma.
Lots to talk about with commodities. It's been an interesting 12 months. I suppose the thing on most people's minds at the moment is the oil price and whether we can trust what OPEC says and that the oil price will rally.
Good question. I think the question of OPEC is really the question of Saudi Arabia and to what extent they're going to exercise their put option and keep oil prices above $50. Now, our belief as a firm is that we have yet to see full compliance from the OPEC cuts so far, and we've yet to see inventories come down sufficiently for OPEC as a body, and Saudi Arabia in particular, to feel comfortable about being more relaxed about cuts, i.e. moving more to a market share approach. So we think it's likely that those cuts will be extended into the summer and possibly even into the autumn. And their discipline is the key. We think Saudi Arabia will probably compensate for any waywardness from the likes of Iraq and potentially Russia, which of course is part of this non-OPEC agreement. So we think OPEC will largely deliver the cuts. We think we see about 70% compliance at the moment. We think there's probably more compliance to come. We need to see the contribution of some of the non-OPEC countries, particularly Russia, to make sure production isn't rising there. But we think the line will hold into the summer, and then we should see the effect and impact of global inventories rolling and start to see it really show up in the most visible inventories, which of course are in the US.
And what does that mean for the oil price? Does it mean finally a bit of stability in 2017?
I think so. I mean, obviously, as long investors, we hope so. I think clearly what has disappointed so far this year is that we have seen inventories again in the US creep up. Now, that's a bit of a surprise, but in the context of global inventories, where our various data sources suggest they're coming down, we think it's more of a lagging effect. So when we see the maintenance season for refineries in the US roll off and we see uptime move back up to higher levels of utilization, we think we'll see those inventories come down. The one caveat is, of course, the shale production in the US. And the one slightly negative surprise from the point of view of supply-demand, and that's probably making the Saudis feel a little bit nervous, is that we're starting to see production ramps again in the US, particularly in the Permian Basin.
And from oil to gold, because that's the other thing that always people think of when they think of commodities. Gold, of course, has also been in the headlines over the last year, mostly because of the political uncertainty we've had over the last year. And generally, gold tends to be a flight to safety. However, we've also had markets rallying in a way that you don't normally have when you have political uncertainties. So where are we with gold at the moment?
Gold is obviously an eye of the beholder type investment, and gold usually functions when other things are not working, and therefore I think gold took a little bit of a backseat when we saw the Trump reflation trade coinciding with a rise in interest rates, where we've seen 10-year yields go up. Obviously gold has historically, apart from anything else, been a bit of an opportunity cost investment. So obviously the opportunity cost of owning gold goes up, if you like. It's more expensive to own gold when 10-year yields, the yield on money is higher because you're missing out on that yield, particularly if there's not particularly much inflation. So real yields are there. I think on the flip side, it may very well be that at some point we see yields start to compress again. That's certainly the work of those bright people at Hoisington Investment Management in the US, who are long-term 30-year treasury investors. And I think that's the feeling among many economists in Europe, that we may well see yields compress, and that may well change the environment for gold. We may well see gold come back into focus again as that opportunity cost effect diminishes. And then the other side of the barbell, and again, this is why people tend to own gold, is the systemic risk. If we see problems manifest themselves in Europe, it's going to be a busy summer in Europe. We've still got to see, what happens with the various problems that Trump is going to encounter as he rolls out his plan. We may have geopolitical issues. Gold, generally speaking, in a period of systemic risk, is seen as an attractive investment. So you've got two sides of a barbell there. That's why we are modestly constructive on gold and gold-related investments.
Michael, thank you very much.
Thank you, Emma.
This is Emma Wall for Morningstar. Thank you for watching.